Standard Bank's earnings have grown slightly. The lender says it grew by low to mid single digits in the 5 months to end May, and it's commented that growth in rand terms was negatively impacted by movements in average currencies relative to the local unit. Standard Banks pointed to Angola, Malawi, Nigeria and Zambia in particular. The banks added that it remains committed to delivering positive jaws and a full-year return on equity that's well anchored inside the group's target range of 17 to 20%. Standard Bank set to release its results in August. Nampak's eyeing a return to the black. The packaging company expects to report interim headline earnings per share of 30 to 34 rand. Nampak cited an improved performance by its continuing operations. It's also pointed to progress on asset disposals, cost reduction initiatives and lower forex losses. The company is set to open its books next week. Sasol Oil's legal tussle with Transnet has come to an end. The High Court has awarded Sasol Oil 3.9 billion in damages plus interest of about 2.3 billion rand. The legal action relates to Transnet breaching an obligation to set pipeline tariffs for conveyance of crude oil in terms of a deal signed in 1991. Sasol says that breach resulted in Transnet overcharging Sasol Oil for the conveyance of crude oil over a number of years. Harmony's annual production is set to shoot the lights out. The bullion producer expects to exceed its guidance of 1.55 million ounces and says it will also meet grade and cost guidance for the period. Harmony's added that operating free cash flow generation continues to be exceptional due to improved recovered grades and a higher rand gold price received. Sirius Real Estate says it's made good progress on its acquisition pipeline following 6 months of active investments in Germany and the UK. That comment follows an update of a recent purchase. The owner and operator of branded business and industrial parks has bought 2 assets in the UK and says it's paid over 31 million euros. CEO Andrew Coombs says the acquisitions present the company with a number of value-add opportunities to utilize the Sirius platform to grow income and value. Further afield, data from Europe's auto industry body showed that sales of new battery electric cars in the European Union dropped 12% in May from a year earlier, led by a 30% plunge in Germany. Let's take a look at this package report for more.
Sales of new battery electric cars in the EU dropped sharply in May. They were down 12% from a year before, led by a 30% plunge in Germany. That's according to data released Thursday by Europe's auto industry body. The market share of fully electric cars fell to 12.5%, down from a year ago. However, electrified vehicles as a whole, including hybrids, made up just under half of all new EU passenger car registrations in May, slightly up from the year before. Overall new car sales in the EU fell 3% in May from a year before. Demand for EVs in Europe has cooled in recent months after rising strongly for several years. Competition to produce more affordable models has also grown. Last week, the European Commission said it would impose tariffs of up to 38.1% on China-made EVs from July. It's aimed at protecting domestic automakers from an influx of cheap EV imports. Tesla said last week it expected to raise the price of its China-made Model 3 due to the EU measures. Elon Musk's company recorded a drop of more than a third in May sales in the EU.
And fossil fuel use hit a record high in 2023, even as many world leaders vow reduced emissions time after time. Here's our reporter Dowling Lachela with more.
That's right, Zinati. This is according to a statistical review of World Energy Report highlighting the record use of fossil fuels around the world. However, it's noted that fossil fuels' share of the global energy mix decreased slightly on the year. And joining me with further insight is DW correspondent Cassandra Sint. Cassandra, thanks so much for your time today. Now let's get straight into it. Right at the top, just unpack the report for us.
Thanks for having me. Well, the report found that overall energy use is going up, and while fossil fuels are making up less and less of a percentage of that demand, fossil fuel use still grew last year because of that overall growth. Currently, fossil fuels amount to 84% of the energy mix for non-OECD countries. That's according to the industry's statistical review of World Energy Report, which came out today. Another piece of bad news is that the world also hit a record high of 40 gigatons of CO2 emitted last year. Now, I looked up how much a gigaton is, by the way, and just 1 gigaton is the same weight as 6 million blue whales. So that's a massive amount of carbon dioxide that was emitted in 2023. The head of the agency that conducted this report said that they hope that the information will help governments, world leaders, and analysts move forward with clear eyes about the challenges that lie ahead. The chief executive of the Energy Institute said that there is a sign that the demand for, quote, fossil fuels is peaking, but whether we've seen the top of this mountain has yet to be seen. The report notes that since the year 2000, emissions from energy have increased by 50%.
And what about renewables? Is there a slower uptake on that front?
Right. And renewables have been scaling up in recent years, but so has global energy demand. That seems to be a sticking point for the transition to a lower carbon energy future. The report notes that the increase is mostly driven by increasingly competitive wind and solar energy. When we look at the growth in power generation, the report found that 74% of net growth in overall power generation came from renewables. All of this is important because scientists have been warning for years that if global temperature increases reach 1.5 degrees Celsius, that's a threshold beyond which impacts like drought and flooding will become more extreme.
Lastly, what does the report tell us about demand in different regions? There must be differences based on economies.
That's right. And it's also important to note that 2023 was the first full year of rerouted Russian energy flows following sanctions from the West after Russia's full-scale invasion of Ukraine. Also, 2023 was the first full year without major movement restrictions linked to the COVID-19 pandemic. But all of that being said, here are some country and region specifics that jumped out at me. In India, fossil fuel accounted for nearly all of the demand growth in 2023, while China's fossil fuel growth rose by about 6%, hitting a new high. But at the same time, China added more renewables than the rest of the world put together last year. The report also notes strong differences between regions. For example, collectively, Africa and South Asia, for example, consumed less than 10% of the world's energy demand in 2023. Meanwhile, North America and Europe both saw slight negative growth in electricity demand, in particular because of energy efficiency regulations and lighting, according to the report, as well as changing consumer habits. Here in Europe, the fossil fuel share of energy fell below 70% for the first time since the Industrial Revolution.
Cassandra, let's leave it there. Thanks so much for your time and insights. That was Cassandra Sint from Deutsche Welle.